The US economy has been under the microscope lately, with inflation rates continuing to fluctuate and the Federal Reserve taking action in response. Now, you might be thinking, what's really going on with inflation, and what does the Fed have to do with it? Don't worry, I've got you covered. Let's break it down and make sense of these complex economic shifts. First off, let's talk about inflation. Inflation is essentially the rate at which the general level of prices for goods and services rises. And subsequently, the purchasing power of currency falls. So when inflation is high, you're paying more for the same items you were buying before. And let's face it, we've all felt that sting when we go to the store and realize our grocery bill is a lot higher than last time. But why does this happen? Inflation can happen for several reasons. First, when demand for goods and services outpaces supply, you get what's called demand pull inflation. Picture this. Everyone wants the newest iPhone, but there's only a limited number available. Prices are going to rise because people are willing to pay more for it. Then, there's cost push inflation, which happens when the costs to produce goods go up, and businesses pass on those costs to you, the consumer. You know, when gas prices shoot up or raw material costs increase, and manufacturers have to raise the price of products to keep up. Now let's talk about the Federal Reserve, or the Fed. The Fed is the central bank of the United States, and it plays a key role in controlling inflation. One of the tools the Fed uses is interest rates. When inflation gets too high, the Fed raises interest rates to cool down the economy. And here's the thing. If you're thinking, okay, higher interest rates, what does that really mean for me? Well, when interest rates go up, your credit card bills might get more expensive, your mortgage rate could rise, and car loans might be pricier. Basically, anything tied to borrowing money becomes more expensive. Recently, the Federal Reserve has been aggressively hiking interest rates in an attempt to curb inflation. And this has been the case ever since the inflation rate began soaring above the Fed's target of 2%. It reached 9% in 2022. Some analysts argue that the Fed's actions have worked to bring inflation down. The most recent reports show inflation is cooling off slightly, but it's still well above what the Fed wants it to be. On the other hand, the Fed's rate hikes have caused some businesses and consumers to pull back. So what does this mean for you and me? Well, for one thing, we're seeing an increase in borrowing costs, like I mentioned earlier. But inflation isn't just about numbers. It affects how much you pay for everything, from your morning coffee to the rent you pay every month. The higher inflation goes, the more you'll feel it in your wallet. And the reality is, some people have been hit harder than others. Lower-income households tend to bear the brunt of inflation because they spend a larger portion of their income on essentials like food, gas, and housing. One sector that's been especially impacted is the housing market. Mortgage rates have risen significantly as the Fed hikes rates, leading to higher monthly payments for homebuyers. It's also made it tougher for first-time buyers to enter the market and for homeowners to refinance. But don't count on a quick solution. The Federal Reserve has signaled that it might keep interest rates high for a while to ensure inflation is firmly under control. This means we might be in for a period of slow growth or even a recession, as the effects of high rates continue to ripple through the economy. However, not all hope is lost. Some experts argue that inflation will eventually come down as supply chains recover and energy prices stabilize. Others point to the role of technology in reducing costs, such as innovations that increase productivity and efficiency. The truth is, no one really knows how this will all play out, and the Fed's moves will certainly be a big part of that equation. So, what can you do to prepare for the inflation trends and Fed actions we're seeing? First off, keep an eye on interest rates because they'll impact everything from your credit cards to your mortgage. You might want to consider refinancing if rates have peaked and you're looking to lower your payments. It's also a good idea to stay on top of your budget, keeping a close watch on how much you're spending as inflation impacts the prices of everyday goods. As we wrap up, it's clear that inflation and the Fed's actions are going to continue to shape the economy in 2024. Whether the Fed's strategy will work or not is still up in the air, but one thing is for sure: we all need to stay informed and be prepared. What do you think about the Fed's actions? Will inflation come down, or will we see a bumpy ride ahead? Let me know your thoughts in the comments below. Don't forget to like, share, and subscribe.